What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. This year marks the 40th anniversary of the Russell U.S. indexes, and we've got a great panel of guests from FTSE Russell, CBOE, and the CME Group joining me today to discuss the Russell Recon. We're going to discuss what the Russell Recon is and dive into its impact on products, exchanges, and most importantly, you, the individual traders and investors. Tune in for expert insights on market trends, the use of derivatives for hedging, and how Russell 2000 options and futures can help tackle reconstitution-related volatility. Let's get started. Today's podcast is sponsored by FTSE Russell and TradeStation. FTSE Russell is the home of the Russell 2000 Index. To learn more about FTSE Russell and the Russell Reconstitution, click the link in the description below. You'll also find a link to download the full presentation from today's episode so that you can access this information at any time. And for more information on FTSE Russell and their products, please visit FTSERussell.com. Serious futures traders, level up your skills with TradeStation's powerful platform. Enjoy flexibility, superior trading power, and save big with 50% off brokerage fees for the life of your account, and get 10% intraday margin rates on 3 popular futures markets. Open a new futures account today at tradestation.com/Anthony. All right, traders. First up, we have Catherine Yoshimoto, Director of Product Management at FTSE Russell. Today, Catherine's going to give us an overview of the Russell Reconstitution, how the annual rebalancing works, and why the annual rebalancing is important for both markets and investors. Hi, Catherine. Welcome back to the show.
Hi, Anthony. Thank you for having me back. It's a pleasure to be here.
It's great to have you back on the show. I look forward to the show every year because, as we say with the Russell 2000, it's really different than all of the other indexes. And each year I get an education on, what really goes on the inside of the rebalancing with the Russell Recon. And we always lead off the show with you. And, I'm looking forward to it again this year. As we said, it's a special year with the 40th anniversary. So, Catherine, kick us off. What's going on this year with the Russell Recon?
Yeah, I'll just start with a recap of the Russell indexes. Many of your listeners are probably already familiar with the small cap Russell 2000 and large cap Russell 1000 indexes, which, as you said, were launched in 1984 as the first broad market index series with modular components that add up to the broad cap Russell 3000 index. And then the growth and value indexes were launched in 1987. And so this Russell Reconstitution, the annual rebalancing, is a critical part of maintaining those indexes. Now, especially because in light of the adoption of the Russell indexes, which has grown since their launch, especially among institutional investors, with $9 trillion in assets benchmarked as of the end of 2022. What resonated with those institutional investors tracking the Russell indexes were the objective, comprehensive, and modular construction, which is maintained thoroughly through scheduled reconstitutions. Russell indexes are maintained daily for corporate actions, quarterly share and float updates, and IPO additions in an effort to mitigate the turnover impact at the annual reconstitution. So there are quarterly IPO additions, but really the annual rebalance that occurs in June is the big rebalancing event that really resets the membership of the large cap, small cap, growth and value, and all the different segments that add up to the Russell indexes. The annual reconstitution is a critical part of maintaining the representativeness of the Russell indexes as markets do change, and so do the companies that should be defined as small cap, large cap, growth, or value. Going back to your question about, what's changed this year, a lot's gone on in the markets. Indrani will cover more of the macroeconomic picture next, but this slide gives you a visual overview of the rank and banding process in constructing the Russell indexes, which has largely stayed true to the index design since the inception of the Russell indexes 40 years ago. We start with a universe of approximately 7,000 securities, which are then, ineligible stocks are removed down to 5,000 securities. And then, the segments are created from there down to the 3,000 that make up the Russell 1000, Russell 2000 indexes. As you can see, there are also turnover controlling bands to try to mitigate turnover at the annual reconstitution that are applied between the size segments. And today also we have the style banding as well, since the style indexes methodology was enhanced back in 2011. So this process is consistent, and people like the stocks, the companies are re-ranked in order of this year's rank date to make sure that we're capturing changes in the market.
Quick question on this. How much of this is done just automatically, and how much of there is an input from the human element?
There's a lot of research that goes into the securities. I didn't include the nationality slide, for example, or the index construction summary rules in this deck in order to try to be short. But, obviously all of our rules are transparent. They are posted to our website. There's a lot of research that goes into, let's say, the float, for example, or nationality. That being said, there is, it's a balance of qualitative and quantitative processes that go around the ranking process. So certainly there's a lot of automation that supports the Russell rebalancing.
Thank you.
Did that answer your question?
Yeah, exactly. Perfect.
In terms of this year's key dates, rank date was April 30th, and we'll be announcing preliminary additions and deletions on May 24th. That's followed by what's called a 2-week query period, which ends June 7th. Now, we just talked a little bit about the qualitative nature of some of the research that goes in, like float and nationality. So that's what this query period allows for, to look a little further if there's any question as to the country classification designation of some of the stocks that make it ineligible, for example, or voting rights. That's an important addition that Russell Indexes made about a little over 5 years ago, because we do believe that securities must be investable in order to be in the indexes, a truly investable U.S. equity index series. So that query period ends June 7th, and then we enter the lockdown period. And any updates to the membership will continue to be posted on the Fridays. So from the Friday, May 24th, where the initial additions and deletions to the Russell 3000 and microcap indexes are posted to our website, and clients get additional details naturally on additional indexes that they're subscribed to. On the Fridays, the public Russell 3000 microcap lists, additions and deletions will be updated on those Fridays leading up to the reconstitution day of June 28th. So, we talked a little bit about, why is it such an important event? The assets tracking I mentioned earlier, there's $9 trillion tracking the indexes. As passive investing has grown and just the following of the Russell indexes, I'm sure there's a lot of debate as to what contributes to, the size of that trade. That being said, Russell Recon Day is one of the busiest trades in the trading days in the U.S. equity markets, culminating last year in the $134 billion traded at the close of last year's reconstitution across NASDAQ and NYSE exchanges. Now, this is a very orderly process. I showed you the schedule earlier where we talk about the calendar and what the market can expect in terms of the schedule of communications of the changes that go into the indexes. There's also a robust ecosystem around the Russell US indexes, including active passive funds and derivatives like futures and options that help hedge around the rebalancing event. That's also why FTSE Russell makes sure there is clear communication to the market as to what is changing and when, so that the annual reconstitution continues to be an orderly rebalance event, largely viewed by the market as a liquidity event, not disruptive. We do have a lot of support around that. Sell side market makers are already researching, the changes that are going. They're making their predictions, ahead of the announcement date. And also we, at the close, NASDAQ has its closing cross and NYSE has its auction process that supports the liquidity at the close, so that to ensure that the Russell Reconstitution is an orderly event.
Yeah, I'm always blown away at how smooth it happens. It's just like, boom. And all of a sudden, you're just like, oh, the Russell's rebalanced. There you go.
Yeah, we've heard also, even like reporters say, it can be kind of a boring event because it goes so smoothly. But that's what we like. We want it to be predictable and not disruptive for the markets.
Catherine, once again, thank you so much for taking us deep inside what happens in the Russell Recon. let traders and investors leave with one final thought from you on just the overview on how this works.
Well, thank you so much for having me here today, Anthony. I love talking about the Russell Reconstitution. It really goes back 40 years. The heritage of the Russell 1000, Russell 2000 indexes rolling up to the Russell 3000. Really is an important benchmark series for the market. And rebalancing is an important process that makes sure that the large cap, small cap, growth and value representation, what's represented by the Russell indexes, remains accurate. So, and also in order to make sure that we are providing an orderly process and event, we provide a lot of communication to the market as to what's changing when. As I mentioned earlier, the timelines are and the rules are published to our website, as well as, the incorporation of feedback like the query period, as well as working with the exchanges like NYSE and NASDAQ to make sure there's an orderly process at the close of reconstitution.
Catherine, thank you again so much.
Thank you.
All right, traders. Next on deck is Indrani Day. She's the head of global investment research at FTSE Russell. With Indrani, we're going to go over an overview of the Russell US indexes in the past 12 months. A lot to cover there. Industry returns highlight several themes that Indrani is going to go over, and we're going to discuss the correlation between economic growth and size index breakpoints. Indrani, welcome back to the show.
Thanks, Anthony. Always good to be back on the show.
It's great to have you. It's our annual show about the Russell Recon. And, I don't like to pull favorites, but this is really always one of my most favorite segments that we do because we really talk about what's happening within the sectors within it. So we're going to get a macro and just, overview of what's going on inside the Russell Recon. So Indrani, take us through it.
Thanks. So, why do we look at the last 12 months? It's essentially because the Russell indices have an annual reconstitution process. So it's meant to pick up what has happened in the markets in the last 12 months. So everything that I'm talking about is about the 12 months ending April 30th, 2024. And because we are not an investment advisor, this is just for educational purposes. The basic macro backdrop, there are two stories going on. One is growth is slowing, but the US growth is much stronger than the rest of the world. And you see that in the two charts. On the right-hand side is what you are seeing about the expectations for the 2024 growth. What was it in December and what is it in April? And you see that it has trended down for pretty much all the major economies. And on the left-hand side, you see what was the growth in the last 3 quarters, like third quarter of 2023, fourth quarter of 2023, and the first quarter of 2024. And you see that each subsequent quarter has been lower than the one before. So that's the slowing growth story. But if you see the absolute numbers, see how high the bars are for the United States compared to the rest of the world, the US is simply having growth much in excess of the rest of the world. Coming to the other theme that the market has really been concentrating on, the inflation story. We all know that the last leg of disinflation is proving to be quite hard. But what is even more important to consider, because the Fed always says expectations are very important because inflation tends to be self-reinforcing. This is the thing that we really need to keep a note on, that break-even inflation, the expectations about inflation are above 2%, and some of those expectations might have gone up a little bit. So that is something to be very cognizant about. And the other thing is, the Fed itself, its policy rates, it's been the same policy rate since about last July. But yields have gone up, they have gone down, they have gone back up. The yield curve at the end of April 2024 was almost where it was at the end of October 2023, because all the drop that we saw in Q4 has been erased in 2024. So, at this point, it's all about the expectations, the uncertainty, what people are thinking about the future, not what the Fed is actually doing. And I think that's been a very important characteristics of the market. Now, moving from the macro backdrop to what is actually happening in equity markets, just like US economic growth is far in excess in most parts of the world, we are seeing the same thing in equity returns, that the Russell 1000, the purple line, rebased from a year back, Russell 1000 returns have been far ahead of the oil world in the last 12 months. But these last 12 months has certain important themes. If you look at the segments of the US equity market between the large and the small, the value and the growth within the large and small, the consistent story is large cap growth. The returns of the large cap growth at almost 32 percentage points, it's far in excess of the other parts of the US equity market. So large cap growth was a clear winner in the last 12 months. But this last 12 months, instead of looking at one number, it's kind of interesting to see it on a time series graph, because it's almost as if the last 12 months have had 4 subsegments. Starting early April, that was well into the period when the AI rally was really on and large cap growth was doing very well. Then we had a general pullback in the market when the Russell 2000 sold off more than the large cap Russell 1000. And then once the market became convinced that the Fed is not going to increase rates anymore, there was a strong catch-up rally by the small caps. And November and December, what you see in that circle, small caps really rallied strongly. And again, as this year, 2024 has begun, it's again been the rally of the large cap growth. So the last 12 months really has separate segments almost in terms of the nature of the market underneath. Now, coming a little bit into the industries, and these are the 12 ICD industries, technology was by far the best performing industry. And I might want to point out that tech being the best performing industry, this was true both in the large cap Russell 1000 and in the small cap Russell 2000. But what is important is how each of these indices are exposed to technology, meaning the weight in technology of the Russell large cap, it's almost 33%. Almost 1/3 of the large cap index is technology. In the small cap, it's a far smaller, just around 14 percentage points. So that exposure to the tech industry is very different across large and small. And if you look at the tech concentration in the Russell 1000 growth, it's really strong. More than 50% of the index, 53% to be precise, of the Russell 1000 growth comes from technology. So if you are in Russell 1000 growth, you're very heavily exposed to the technology story in the United States. Now, where are the markets right now? I mean, on the left, you see the analyst revisions. This is the revisions in earnings, which is really a earnings momentum story. And you see that the earnings momentum is slightly negative for the Russell 2000, the small caps, and neutral to slightly positive for the large caps. And on the right-hand side, you see the 12-month forward PE for the Russell 1000 and 2000. And we see that a lot of the market returns have really been because of the valuation re-rating. The forward PEs for both large cap and small cap have moved up, particularly since the rally that started November. And now if we step back and say, indices are a representation of the market, the Russell indices are the US equity representation. So how closely do the Russell US equity indices track the underlying US economy? Now, the logic of this graph is it's capturing the GDP growth rate in the US, and the gray line is the change in the breakpoint between the Russell 1000 and the 2000. And the intuition is if GDP growth in the US is stronger, companies grow stronger and larger, and then the breakpoint between the Russell 1000 and the Russell 2000 should move accordingly. And as the graph showed, it is indeed true. The breakpoint between large and small closely tracks the GDP growth in the United States. And another interesting point I might point out is the Russell index methodology is constantly being changed to kind of better reflect the underlying US economy. And we see that in the correlation numbers, if you break it into different time periods, the correlation over the entire time period since 1985 is a strong 52%. But in recent time periods, post 2000, it's been 68%. Post the GFC, it's 71%. So the Russell indices are a representation of the underlying US economy because it closely tracks the breakpoint, closely tracks the underlying US GDP growth.
The only real question I have for you is because I'm trading the Russell on a consistent basis, and I'm always looking at what's happening in rates. You can go back and track what happened last November. Basically, the Fed said, it's not necessarily that they were getting ready to cut, but they were done hiking. Like basically they had inflation under control, and you just saw the Russell have, I think, one of the best months I think it ever had in the history of the Russell, which is saying a lot. And I don't know the exact numbers, but I know it was a massive move. Then you get into this year, economy's strong, and we continue to see strong numbers, which is why the Fed's hesitation really here to cut rates. You have the Russell Recon going on. The economy, if it stays strong, but yet the Fed maybe doesn't cut rates this year, which is seeming like that's more and more the possibility. Does this Russell Recon, does it start to break away from that trend that rates are just stuck here? Maybe they stay relatively high, and you could potentially see, the Russell starting to break out to the upside, maybe with the rest of the indexes? Or how do you foresee the rest of the year happening if rates just kind of just stay exactly where they are?
Since we are not an investment advisor, I will not forecast, but I'll point out the trends that you mentioned. Rates, inflation, is it under control? What is the Fed going to do? And accordingly, where rates are expected to be has really been a driver of the markets for quite some time. And in the environment that we are in, probably rate expectations will continue to drive the economy. So there are two things to keep in mind. The Russell 2000, the small cap, is a much more domestic oriented index. So Russell 2000 is to that extent even more exposed to the rate story, which is why, November and December of last year, when there was very strong expectation that the Fed is done with rate hikes and it's going to be cut, and there were quite a few rate cuts priced into the markets, that's when the Russell 2000 really did so well that it really strongly outperformed the Russell 1000. Whereas now, when growth is coming in much weaker and the inflation is still not totally under control, the expectation is of fewer cuts and cuts coming in later, we again see the story that large caps, which are, they have stronger balance sheets, they have more international exposure. So they are again in this uncertain environment. We again have the large caps pulling ahead of the small caps, and it's again becoming a large cap growth story.
Yeah, that's well put. I think it just comes down to, if we know what the Fed is really going to do, these businesses can start operating. I think that the whole question right now is people aren't even sure if they maybe are even potentially hiking. But in the scheme of things, Indrani, what's a quarter point either way? I think that the market's starting to see through that. It'll be very interesting to see how the rest of this year goes. And Indrani, thank you again so much for coming on. Like I said, every year I learn so much from you, and I really appreciate your time.
Thank you so much.
All right, traders. Next up, we have Rick Rosenthal, Director of North American Derivative Sales at CBOE Global Markets. Rick and I are going to discuss the Russell 2000 RUT options growth. Of course, we're going to talk about Russell Recon, volatility, and Russell 2000 option writing strategies. Rick, welcome back to the show, my friend. How are you?
Doing well, thank you. It's a pleasure to be with you today. It's always a pleasure to be on Futures Radio.
It's great to have you back. And, today we're going to kick it off, Rick. We're going to talk about the Russell 2000 index options volume growth. Talk to us about what's going on there, Rick.
So let's do a little recap on what Indrani and Catherine has mentioned already. Recalibrating the Russell benchmarks is really no small undertaking. When you consider the total market cap on the U.S. public equity market is over $53 trillion. Many institutional and retail investors are invested in funds and portfolios that track the Russell indexes, like the Russell 1000, the Russell 2000, but also includes variations of the Russell 1000 and 2000, like growth, value, and ESG. And as Catherine mentioned earlier, in aggregate, there's over $9 trillion in assets tracking these U.S. Russell indexes, and they all go through this annual undergo this annual rebalancing once a year. So it's a big deal, because on the rebalancing day, investors will watch their investment managers add or delete constituents in their respective index portfolios, which results into typically the largest trading volume event of the year. So when you consider the magnitude of $134 billion of equities trading at the market on close, it's quite impressive how FTSE Russell has been able to manage the annual Russell rebalancing, having little, if any, market impact.
Yeah, I know. I'm always amazed by it, because I'm always watching it. I'm always trading, that day, and I'm always like, okay, was there going to be some crazy move? Is there going to see something, happen? And it's really just very organized. And obviously, it's a testament to what's going on prior to that, the transparency, and of course with CBOE and CME, the derivatives markets obviously play a big role in that as well. Obviously, Rick.
Well, at CBOE, there's an opportunity to trade volatility. There's an opportunity to trade on a short-term basis, and that's what I'm going to cover pretty much on my slides, but FTSE Russell really has done a remarkable job creating just a transparency throughout the whole Russell Recon process. So, we're going to take a look at how one might be able to take advantage of the muted volatility during this time period. So at CBOE, we have the exclusive licensing agreement with the London Stock Exchange Group, which allows us to list the Russell 2000, the Russell 1000 cash settled index options only at CBOE. And the Russell 2000 index option is the crown jewel for us. It's the third most actively traded cash settled index option behind the SPX and VIX options. And the growth in the Russell 2000 options volume has come from increasing trading activity, both institutional and retail. And these are market participants looking to find an efficient, cost-effective way to express a market view, manage risks, or trade on volatility. In 2022, CBOE listed options on a mini Russell 2000 index. When you have the Russell 2000 at 2000, roughly, it becomes fairly expensive. The standard contract is 100 times the index, so that's a $200,000 notional. For smaller accounts, it may be a little too large. So we have a mini index that's 1/10 the size of the Russell 2000. And with the index currently at, let's say, 2020, the notional value of this mini index options is roughly $20,000, which is competitive to an options on the ETF. You may be familiar already with the iShares Russell 2000 ETF and the options IWM. Now market participants have the ability to trade a smaller size contract, cash settled index contract, that is comparable to the options on IWM, but receive the benefits of no early assignments because this is a European style contract. You have cash settlement, simply credit or debit, and you have what's unique to these cash settled index options, the 1256 contracts, which means that they have a blended 60-40 long-term, short-term tax rate. That's unique to cash settled index derivatives. Earlier this year, CBOE added Tuesday and Thursday expiries into the lineup. Now, we had those already for the S&P 500, and that's been a tremendous success. We're seeing almost half the daily volume occurring in these 0 DTE options in SPX. So we thought, let's add it to the Russell 2000. And we did that January 8th. And since then, 0 DTE trading in RUT is approximately 13% of the total trading volume on a daily basis. Last year, the total volume in the Russell 2000 index across our 3 exchange was up about 21% year over year, with the average daily volume roughly 70,000 contracts a day. And if you look at that on a notional basis, that's about $14 billion notional. Looking at the volume growth in the mini RUT, let's call it, the index volume growth has been about 52%. The average daily volume, roughly 400 contracts a day. And on a notional basis, that's about 8 million in notional total volume on a daily basis. So given the proliferation of options-based ETFs, which are trading the underlying options on the Russell 2000, we're seeing increasing demand for the growth in income strategies like covered calls or the daily cash secured put rights. And as a result, we're experiencing steady growth from both the fund side, 40 Act funds, as well as the institutional and retail daily participants. So what are some of the unique characteristics of the Russell 2000? Well, Indrani did a nice job recapping some of those unique differences. But one thing to point out, which really surprised me, the Russell 2000 constituents are almost 2/3 of the total Russell 3000, which is capturing the vast majority, if not all, the publicly traded equity companies in the US. So in total, the Russell 2000 has a market cap of about $3 trillion. And to put that into perspective, if you look at the total market cap of the Russell 2000 compared to Apple or Microsoft, just each of those companies, it's about the same. So, you have almost 2,000 constituents that have a total market cap equal to Apple or Microsoft. So this is an important thing to note because of the small cap nature of these companies. Another thing to keep in mind, the industry weightings are quite different. For example, the Russell 2000, the top 3 industry sector weightings are industrials, healthcare, and financial. That's about 49% of the industry weightings for the index. On the other hand, the top 2 industry sectors for the Russell 1000, information technology and consumer discretionary, about 47% of the index. The overweighting in information technology has contributed significantly to the Russell 1000 outperformance. Small cap companies are typically financially leveraged. In fact, many of them have negative earnings, so they're quite sensitive to changes in interest rates. Interest rates will have a significant impact on the small cap earnings. So one should expect when the U.S. small cap market segment is experiencing growth, and oftentimes when interest rates are going down and you see domestic growth in the U.S., the Russell 2000 tends to outperform the large cap counterparts. So by nature, small cap companies are less liquid and they're subject to greater price movements. The higher the volatility in small caps fosters demand for hedging against downward price movements, which creates income generating opportunities for risk takers. And we're going to take a look at that. Options pricing is based on theoretical values coming from options pricing models like Black-Scholes. Volatility is an integral component of options pricing, which is incorporated into what is the value of a listed option. And that includes both realized volatility or 30-day historical volatility and implied or 30-day expected volatility. Using the same methodology for calculating the widely followed VIX index, which is 30-day expected volatility on the S&P 500, CBOE created a Russell 2000 volatility index, ticker RVX, which is also derived from options pricing on the Russell 2000 index. And it calculates the 30-day expected or implied volatility on the Russell 2000. You can see in the chart here, RVX reflects a level of bullish or bearish sentiment on the Russell 2000. On average, the 30-day implied volatility on the Russell 2000 is about 24, which means that the sentiment in the marketplace is that there's an expected price range of the Russell 2000 going up or down by 24% within a 30-day time period. And what we saw during periods of market duress, as seen in the global financial crisis in 2008 and March of 2020, the Russell 2000 declined sharply, and that led to the RVX index spiking to levels that were above 80. In fact, the all-time high was 87.62. So when volatility increases, and looking at RVX as one measure of volatility, there's this inverse relationship. So when you see volatility increasing, typically the Russell 2000 will tend to head lower, and when volatility declines, the Russell 2000 will tend to go higher. And that's reflected in the implied volatility in options pricing. So trading listed options provides an opportunity to express a bullish or bearish view on the market. It allows market participants to manage portfolio risk, and it also allows investors to harvest volatility by collecting premiums from selling calls and puts. Most of our valuable assets, like a house or a car, they're insured, and we pay an insurance premium to cover the potential loss in property value. Similarly, investors are willing to pay a premium to hedge against downward price movement in the Russell 2000. And that's reflected in a higher implied volatility on the index, a higher implied volatility on puts. And then when you compare the implied volatility on RVX to the implied volatility measured by VIX, there's typically a premium in RVX over VIX of about 6%. So for those market participants looking for opportunities to harvest volatility using option writing strategies like a covered call or a cash secured put right, or credit vertical spreads, iron condors, trading options on Russell 2000 may offer opportunities for higher returns. And something worth noting, this is a recent development. Within the last 60 days, FINRA recently approved a rule change on protected options. So most people may be asking, what is a protected option? So protected options is a margin relief for those who carry an underlying position in, let's say, IWM. So they own IWM. They can now sell calls using cash settled index options against their IWM positions like a covered right strategy. And one does that when the notional value is the same. So in this case, IWM, same dollar denomination as MRUT. One can sell one contract of MRUT against 100 shares of IWM and get the same margin relief as a covered call strategy. The benefits of using, let's say, the MRUT, which is a cash settled index option, is that you get the 60-40 blended long-term, short-term tax treatment that's not available in options on ETFs. So CBOE has created literally hundreds of strategy benchmark indexes which measure the performance of various option writing strategies. And on this slide, we selected 3 primary strategy benchmark indexes, which are based on the Russell 2000. We have PUTR, which is the ticker for the cash secured put right. We have BXR, which is the buy right on the Russell 2000, and BXRD, which is the 30 delta buy right on the Russell 2000. Now, I selected these 3, even though these are strategy benchmark indexes measuring a systematic every month selling a call or selling a put against an underlying own holding of the Russell 2000, or in the case of the cash secured, let's say T-bills. It illustrates the point that during the Russell Recon period, these benchmarks have a tendency to outperform the underlying index. Why is that? Because they're harvesting the premium. They're taking in, collecting the premium when the implied volatility is, let's say, at a higher level relative to realized volatility. So during the Russell Recon process, the rebalancing has had a minimal impact on the market in general. And over the last 15 years, investors have had the ability to harvest the risk volatility premium, the difference between implied volatility and the 30-day historical or realized volatility. And you can see from the table, as a result, you've had the ability to, and it's not the same for each year, but a put right seems to have been outperforming the Russell 2000 3 times, and the BXRD has been able to outperform on one occasion, BXR on 3 occasions or 2 occasions. The index itself is just indicative of the opportunities to capture that volatility risk premium. Market participants are using, let's say, 0 DTE type or small or short dated trading strategies and harvesting volatility with, let's say, credit vertical spreads or straddles or strangles. So again, these are just points of illustration. With CBOE offering the standard and mini index options that have daily expirations, there's ample opportunities to harvest volatility trading options on the Russell 2000. So I know I'm throwing a lot of information at the audience in this short segment, but I want to point out that we have a number of webinars. We've got Mandy Zhu producing her weekly insights. We have guest author blogs going into use cases, and we have our annual risk management conference, which you can see posted the link to come to our website and learn more about it. I encourage everybody that wants to learn more about options to come to www.cboe.com. There's plenty of information on our webinars, blogs, and events.
Rick, that was excellent. I mean, I'm so glad that you brought up the RVX, and it was very interesting for me to learn that the 30-day expected volatility carries a 6% higher volatility level compared to the S&P 500. I think that'll be extremely interesting out there to a lot of Russell and S&P traders to start looking more at what's going on in the Russell. And another stat that I thought was pretty interesting was that you guys have SPX, then VIX, then the Russell is right there in third in terms of total volumes per day at CBOE. I thought that was pretty incredible to see how much the Russell continues to grow as a product. And obviously, we talked about the Russell Recon, just the seamless reconstitution of it every year, and how CBOE plays such a instrumental role in how that all occurs. Rick, you're the best, man. I can't thank you enough for coming on the show, and I look forward to maybe someday, Rick. I think what I have to do is I have to do a futures radio show from the CBOE new floor. I haven't been there yet to check it out, but it looks very cool.
Thank you, Anthony. We'd love to have you. broadcast from our floor anytime.
All right, traders. Next up is Paul Woolman, Managing Director and Global Head of Equity Index Products at CME Group. Paul and I are going to discuss, of course, the E-mini Russell 2000 futures and options at CME Group. We're going to talk about using E-mini Russell 2000 futures around Russell Recon, the reconstitution. We've talked about that so far in this show, how it's really a seamless transition through the recon and how CME plays in a very important role in the reconstitution. And of course, we're going to talk about the E-mini Russell 2000 index futures, and we're going to give an EFP example. Some of you may be wondering what that is, and that's why we're going to bring in Paul to discuss that. Paul, welcome back to the show, my friend.
Thanks, Anthony. Great to be here.
Great to have you back. Excited to hear what you have to say about Russell Recon. We've had just a great panel so far, and really excited to hear what CME does during the recon. I mean, so many of our traders out there are trading the Russell 2000 futures, and going to be very interested to see what the exchange says about Russell Recon.
Yeah, well, thank you. So, I mean, Russell Recon's always an exciting trading event, highlight of the trading year, I would say. So, great to discuss how some of the derivative products we've got available at CME can be useful to trade around the Russell Recon itself. First, just to start, we've got the disclaimer on the screen, not giving any investment advice per se today, but again, just going to give some educational points around our product offering. So if we think about just how can clients access Russell 2000 or even Russell 1000, they can do it in a variety of ways. So one is to hold a cash portfolio. That's very common, but when it comes to trading around Russell Recon, that might mean you have to trade in excess of 3,000 stocks if you're trading around the Russell 2000 and the Russell 1000. And from an operational burden perspective, that's a high operational burden. And so what a lot of investors look to do is really try and outsource that problem by trading an index-based product. That means someone else has to do that operational task, and you just track the index-based product. And different index-based products are out there. Obviously, futures, very liquid and efficient. We're going to go through some of the advantages of futures, but also you could trade on swap, you could trade an ETF, or as Rick pointed out, you can trade options. But really, if we compare the advantages and disadvantages of all these product wrappers, they all have various pros and cons. It's not that one particular instrument is better than another per se, but what is clear is that when we talk about futures, they've got some key important advantages. And the first one really is liquidity. So huge liquidity in Russell 2000 futures at CME Group. It's really improved since the contract came back to CME several years ago. And the other element of this is you can trade the product around the clock. So you don't just have to trade around US hours, but you can trade it in the overnight hours too. And be able to source liquidity around the clock in this day and age when there's news flow hitting all the time is extremely important for investors. Another important thing about futures is the capital efficiency available. So when you think about it, it's not a fully funded product. So that means you don't have to put all your money into the product up front. Here, you have to put down some initial margin and then maintain maintenance margin after that. Another thing is the ability to go short as well as long. So with a future, that's very easy. There's no borrow required. You can operationally just as easily go short as well as long. And so some of these things are really important features around futures. One thing to bear in mind with a future is it does have a fixed maturity. So you will be required to roll it as it nears the end of the maturity of the particular contract that you're in. So these are just some of the things to keep in mind. If we think about the Russell suite, since it's been back at CME, we got the Russell 2000 back in 2017. And as I say, liquidity is going from strength to strength. We've also invested a lot in terms of broadening out the portfolio of products that are available. So we've launched total return futures, most recently adjusted interest rate total return futures. And these products are starting to trade strongly. We've also seen more recently addition of Russell 2000 dividend futures, and they're being traded more actively. And of course, we have functionalities like BTIC and EFPs, which we're going to talk about a little bit more in depth. But a further thing was the introduction of the micro E-mini futures back in 2019. We've just had our 5-year anniversary. These products have been hugely successful in terms of liquidity and really given further access to active retail investors alongside institutional accounts who are looking to fine-tune their positions. So you have the E-mini contract and the micro E-mini contract available side by side. If we think about E-mini Russell 2000 futures and options at CME, we can see that they perform very strongly. And as I said, one of the key factors is liquidity. So when we look at E-mini Russell 2000 futures, they're trading over 220,000 contracts a day this year. That's over $22.5 billion of notional traded daily. So a huge amount of liquidity available via these futures. On top of that, you have the micro futures. They're trading 87,000 contracts a day. That's almost an extra $1 billion of liquidity there. And that's available in this fine-tuning aspect. We also have options available. These are options on futures, and they're increasingly being used and increasingly popular. Now, when you compare the liquidity available in, say, the E-mini Russell 2000 future, what you see is that it trades over 3 times more than all the most liquid ETFs that track the Russell 2000 combined. So a huge amount of liquidity available in this product set, and that's what our clients love, and that's why they turn to CME in order to invest via an index-based product such as a future.
Yeah, one thing I will say, Paul, I remember when the micros were coming out for the equity indexes, and as an index trader for over 2 decades myself, I was interested to see how the marketplace was going to react with yet another product, right? And it just really fed off of itself, right? I mean, as the micros got more popular, a lot of people came into the space, better products to hedge, specifically hedge and manage risk. And I think it's continuing to grow the actual bigger products as well, which I think is really fascinating because, as CME, I know as I've talked with you guys so much about this, that, you wonder how is it going to help or hurt the other products. And overall, it's lifted all tides. You've seen volumes go up across the board.
No, that's right. And what you see with many of these products is where there's these fears of cannibalization in some way, they don't really exist. What you find is it taps into another investor profile or is additive and complementary along to the original products. In this case, the micros being very complementary to the E-mini sized product. And both institutional clients using it to fine-tune their positions, especially in things like segregated accounts or where they need to trade a smaller hedge for whatever reason. But also, if you think about the active retail trader, lots of retail traders are now expressing their investing positions via futures, able to invest in this smaller, more nimbly sized contract. So yeah, it's been a great success, and 5 years have flown by, but really great to see the success of micro mini futures.
Yeah, specifically during this time when you have a Russell Recon, if you own some IWM and you've got your account up and you have access to futures, you can go in and you could use the micros or the big contracts. So you can really precisely hedge during this time if you feel that you need it, or you could just trade the price action. And I think that, we don't talk enough about how much the micros have really accelerated. I just think the popularity of futures in general, just such a great product.
Yeah, no, completely agree, Anthony. And what's interesting is, of course, when we talk about the Russell 2000 Recon, a lot of people focus on Russell 2000 itself, but there's the Russell 1000 as well. And, the Russell 1000 futures at CME are starting to trade more and more. If we look at the sort of green line on this chart, that represents open interest. So that's positions that clients hold open overnight. And as you can see from this suite, which includes Russell 1000, but also the Russell 1000 value and growth versions of futures, you can see that actually we're at all-time highs in terms of open interest. What's interesting is that out of these 3 products, the one that is traded the most is actually the Russell 1000 value. So that's where a lot of clients are active and wanting to take positions. And in terms of the trading style, what we've seen over the last few years is that people have started to trade via blocks and BTIC a lot more and not just using the order book. So, great to see this activity. And it, again, is another complement sitting alongside by side the Russell 2000 activity. So now we're going to talk about the Russell 2000 Recon itself. and really how futures and some of the functionalities that we have available at CME can help investors navigate the reconstitution. And two primary ones are BTIC and what we call exchange for physical, or EFP. And BTIC stands for Basis Trade Index Close. And what it is a way to trade a future against the cash index close. So when you're at the top of the show, when I was speaking about potentially looking to outsource your index rebalancing operational needs by using an index-based product, here you can use either of these two functionalities to switch into a future, and at a later stage maybe flip back to a cash basket should you wish to. But what BTIC does is allow you to trade a basis intraday. So you agree to a basis intraday, and then that basis gets added to the cash index official closing price later in the day, and that's what you'll buy or sell a future at. So in this example, we have trader A trading against trader B. Trader A is buying, and they're going to use this functionality, BTIC, Basis Trade Index Close, in order to buy 500 contracts of the E-mini Russell 2000 index. They agree this intraday, and at the time that they agree the trade, the basis or the BTIC price is plus 90 cents, 0.90. Then later in the day, once the index price is known, and let's say it closed at 2,108, and this is the cash index price, not the futures price, the cash index price of 2108 is realized and is the official index close, which is released by FTSE Russell. Then at that point, the basis that was agreed through this BTIC transaction is added onto that print. And so that would result in a futures price of 2,108.90. And that is where trader A would buy 500 contracts of the E-mini Russell 2000, and that's where trader B would sell it. Now, this is a useful functionality because a lot of clients want to rebalance around the close or adjust their positions going into, say, the reconstitution when they want to outsource their position by trading something else against this on the close. And so this is a really useful functionality. Other clients who are trading, say, the additions or deletions from the index are often doing that against a market neutral position. Again, they could use futures for that, and using BTIC can allow them to move in and out of those futures positions as they're hedged to their addition deletion basket. So really useful functionalities for clients, and hopefully something that we'll continue to see clients take advantage of. Just for background, the volume being used by BTIC this year on Russell 2000 is up something like 20% over 2023. Now, a second functionality that is very popular with clients is an exchange for physical, or EFP for short. And in this example, really, we look at the starting position of both a dealer and an investor. And what this allows clients to do is really flip a position from one index wrapper or one position into another. So in this case, let's assume the investor is long $295 million of the index via a cash basket. So they're long all the relevant constituents of the Russell 2000 in the right proportions to replicate the index. However, they choose not to want to go through the recon and have to do all the trading that we've described. They want to outsource that problem by buying an index-based product. How could they do that? Well, through an EFP, they can negotiate this with a dealer. And in this case, let's assume that they agree that the fair basis of the future to that cash basket is plus 70 cents, 0.70. And in this case, the client would buy an equivalent number of futures to that $295 million of valuation. Let's say that's at current prices of the future at 2108, that's 2,800 contracts. So the index level price is effectively 2107.3. That plus 70 cents takes us to a futures price of 2108. So the client chooses to sell their cash basket to the dealer chooses to sell a future to the investor. As this is reported to the CME system as an EFP going through, essentially the investor divulges their cash basket, and the broker in response takes that cash basket on. At the same time, simultaneously, the dealer sells 2,800 futures to the investor who becomes long of those futures. And in terms of the final positions of each participant to this EFP, the investor has replaced their cash basket and is now just long 2,800 futures, which is notionally equivalent of their cash basket, but now they hold it via futures. On the dealer side, their position on their balance sheet is that they are long the cash basket, which they bought off the investor, and they are short the futures. Notionally, they're flat, right? In terms of that market exposure, they're flat, but really they have a balance sheet position of long cash, short futures. And this EFP is very, very commonly used. A lot of investors use it to switch in and out of futures and migrate between, say, cash baskets or ETFs into futures and vice versa. So something that's really popular and great tool to use going into Russell Recon.
Paul, thank you so much for explaining the EFP. This is something I had not been too familiar with. I've been talking with you guys a lot about BTIC in the past, but this EFP is very interesting. And yet another way that the exchanges put together a product to help a seamless transition during Russell Recon. Like you mentioned, I could see how this is used during this time and obviously beyond this time as well. So Paul, thank you again so much for joining me. It's always a pleasure to have you back on Futures Radio Show for Russell Recon. Thank you so much for your time.
Thanks, Anthony. Thanks, everyone.